Hi, guys. Welcome back to this special edition. Um, Again, I'd like to talk about what seems to be my favorite subject of late, and that is gold. But specifically, how gold performs during deflationary periods. Okay. Here we have a chart of gold, the weekly chart. And the reason I got prompted to make this video is that we could be heading into a recession soon, maybe later this year, maybe soon, who knows. And usually recessions are associated with deflationary environments. So, how does that affect the price of gold? Okay, I was recently having a conversation with somebody on X. I don't mean to put anybody on blast, but this gentleman David. Um, you can see the entirety of this conversation here if you want to slow it down. But basically, I'm asking him. He's a proponent. He seems to believe that gold goes down during deflationary environments, and I brought up what happened to gold in the Great Depression. Okay, and he seems to think that if you keep going lower, I mean, you can read it on yourself, but I want to give you the cliff notes of what this conversation was all about. He says that in a deflationary down spiral, like in the 1930s, it causes money to disappear quickly as people pay off their debts or don't pay them back by going bankrupt. So less dollars in the system equals lower gold prices. And I answered him by saying, again, that's not what actually happened in the Depression. Gold rose in price because the dollar got devalued, despite the scenario you lay out of what should happen to gold when deflationary pressures exist. You are ignoring reality and sticking to a logical theory. In trading, that's the quickest way to go bankrupt, trust me. So here's the reality: gold can go up or down in inflationary or deflationary scenarios. It all depends. Okay. He then goes on to, say that I don't know what I'm talking about. But that's not the point. The point I'm trying to raise here is that people have narratives in their head, and this is a very logical narrative that David brings up. Okay. He is correct. In a deflationary environment, money gets taken out of the system. So there's less money floating around. So that bids down all prices for all goods and all assets, including gold, theoretically. Okay? But here he assumes that the demand for all assets pre deflationary spiral, it'll be the same as it was after the deflationary spiral. Okay? Which is not the case. He assumes, in other words, he assumes linearity. He assumes that if prices, if 70% of the money supply disappears, then prices across all goods and services and assets should drop by 70% equally in the same proportions that they were pre bust. But that's not the case. In the Great Depression, assets went down 90%. Like, you can have stocks going down 90%. Okay? And yet the price of gold went up 75%. I mean, it was confiscated. It was by FDR. He bought it at $20 and then revalued gold at $35 an ounce, which is a 75% increase in the price of gold, or a devaluation of the dollar. But the point remains is that during the Depression, assets went down a lot, not uniformly, and gold was bid up. So all the money went to gold, which was the actual money in the 1930s. People were literally in deflationary environments are wanting to hold cash or whatever is money at the time, which is gold, okay, in the 1930s. So my point is to mention that you can't think that because everything falls in price that gold will also fall in price too. They will just flock to it. Okay, that's the theory behind it. Now, in reality, you don't even have to have a reason. You just have to look at what happened in reality. And in the Great Depression, the price of gold went up in a deflationary environment, which is counterintuitive based on this. Okay, so let's go back to a weekly chart of gold, and let's see for ourselves what happens to gold during deflationary environments. Okay, we don't have to, have any theories, any narratives, or build anything. We just have to look at what happens during reality, because the price of gold reflects multiple factors that are pulling against it. Okay, it's not a univariate analysis; it's a multivariate analysis. Not just one thing affects gold. okay? And multiple factors affect it, but what is the end result? What generally happens, okay? Given these factors. So in the Great Depression, the 1930s, we were living in a completely different monetary paradigm, okay? We were living under a gold standard. You couldn't print money beyond a certain range, and gold was money, okay? But nowadays, we don't live that. We live in a fiat currency standard where the dollar is the world reserve currency, and people can flock to the dollar for safety. They don't have to flock to gold, okay? So let's go back to the biggest event in the past, in the modern era, let's say, in terms of deflationary pressures, in the modern era, meaning this century, and that is the great financial crisis, okay? Here we are let's go back to 2008, okay? And more specifically, let's compare gold here to the S&P 500, the market, okay? So now we have an overlay here on the chart of gold here, and this is the SPX, the S&P 500 in, what is that, magenta, purple, I don't know, okay? Let's go back to 2008. Can you see it clearly? It's right here. Okay, it's right here. This is the price of gold, relatively speaking, and this is the S&P 500. This is 2008, 2007, 2008 crash, okay? Let's see these are relative terms, so it's like percentages, okay? So let's make it a little bit more clear here. This is when the market started tanking, which was like October 2007, okay? And this is when it troughed in March. Okay, so let's put another one here for March. So we can compare what happens to these two assets. Okay. First of all, it's a weekly chart, so it might not seem obvious, but these are big movements that are happening, okay? So as the market was going down, okay, it went from, let's say, plus 1,500%, because it's taking it from all the way back to the inception, 1920s, okay? So it's saying what the return is since 1920. But you can see the difference here. The market went from plus 1,400% to about plus 600%, let's say. So it lost, more than 50%, let's say a 60% drop at the nadir by March, okay? Meanwhile, as it was starting to drop, okay, you can see here that gold was rising. Gold was rising from, let's say, plus 473 to plus 670. So maybe a 50% rise in gold here. This is a big move. A 50% rise in gold as the market went from plus 1,400% to, let's say, plus 1,200%. So it lost 200 points. So maybe the market maybe dropped 10, 15% here. Gold was up a lot, okay? 500, let's say, to 600. Maybe gold was up 20, 30%. So initially gold was going contrary to the market as it was falling. But then as the great financial crisis, as the pain got more in the market, more painful, people had to sell their gold to raise money. Okay, so gold went down. I remember it's up 680% here down to like four something. But gold went from like $1,000 an ounce to like 700. It dropped a lot, like 30%. Okay, but the market dropped even more. Okay, and this was because people were selling gold to raise cash to meet margin requirements. Okay, but as you can see here, it quickly rebounded as the market fell even more. Okay. So you had a period, if you look at from the beginning to the end, gold was up, let's say from plus 460% to the nadir, it was plus 650. So it's up 50% from beginning of the drop to down. So again, here we have proof. And a deflationary environment, gold, very volatile, up. Okay, and if you look carefully, very carefully, and this is another key here. It's tough to see in this chart. But here, at this point right here, I'm going to put a horizontal line, just so you see. Okay, at this point right here, not a horizontal line. I should put an arrow. Yeah, up arrow. Right here. Right here, as gold started rising, I remember this was October of 2008. By October 2008, the market fell another, from October 2008 till March 2009, which is like 5 months, okay? Gold ripped as the market tanked another maybe 20 percentage points. It tanked a lot. Okay, in 5 months, down another 20, 25%. Whereas gold was going up that whole time. So gold started reversing 5 months, and the gold miners too were going up too. So gold started reversing from plus 400 to almost, gold made 50%, I would say like a 50 percentage point move in return since inception, I would say. So it's up a lot, 40, 50% in that 5 month period where the market tanked 25%. Okay, more proof that gold, as there's deflationary pressures, gold is rising. Okay, but then look, after 2009, gold and the market went together. Okay, so this is why you can't be so certain about what gold will do, because look, it could go with the market, it could go against the market. You have no idea. Here, as the market continued going higher, gold dropped after 2011, the big bear market. Okay, we'll get to why I think this is the case, because this is why gold is so unique and contrary to what everybody thinks. Okay, I mean, we can go even further. We can go back to the 2000 crash, where the market from 2000 was cut massively, over 50%. And look, gold during this, again, do I have to do these? Let's do it again. Horizontal lines. Look, from the peak till the trough. Oh, I did a horizontal. No, let's do a vertical line. Vertical line. From the 2000 peak. Give me another one. To the trough of 2002, 2003, beginning of 2003. Okay. From that, gold is up. Gold went from plus 688 percentage points since inception to plus 800. So 33% gain as the market is deflating. It's huge. And remember, let's go back to this point. Let's get rid of these. Just giving you an example. Okay, I'm trying to make it as clear as I can. At this point, okay, house prices kept going down till 2011, 2012. So everything was deflating here. This was the housing crash as well, while gold was going up. Okay, completely opposite, completely a 180-degree turn of what you think should happen in a deflationary environment. People go to cash, yeah, they also go to gold. Cash was king here. But as you can see, gold bottomed 5 months before the market. The market went down an extra 25, let's say 23%, 20 to 25%, while gold is up 40, 50% at a time and continues to go up. Okay? So this is why I want to tell you that, historically speaking, okay, you built these narratives, but just go back to see what happened in reality. Okay? And in deflationary environments, gold tends to go up given all factors on it. Okay? This is a net result of all factors affecting gold. This is what happens. So what you should be focused on is reality and not narrative building. So let's clean this up, okay? And come into a final conclusion of what I think you should be looking at when it comes to gold. Okay, so now we're just looking at the weekly chart of gold, okay? So we saw here that gold went down from 2008, but then bottomed before the market and started ripping, okay? And I think there is more to it than just deflationary and inflationary scenarios. What I think really, really kickstarts the price of gold to go higher or lower is massive uncertainty. Okay, the uncertainty. Remember what happened in 2008, 2009? It was the first time the U.S. tried QE. Okay, there was massive uncertainty. Nobody knew what was going to happen. They thought it was going to be massively inflationary. So gold ripped from 2009 to 2012, a massive run. Okay, massive run from like 100% return. Okay, because people thought it would be inflationary. QE, that is, multiple QEs. But in fact, it didn't turn out to be the case. It was inflationary for asset prices, but it was not inflationary for consumer prices. Okay, so it's not bad. I mean, why would people buy gold when their stocks are going through the roof? Okay, so I'm too, like, oh my God, my assets are appreciating in price. I need some protection. Please help me from making so much money. All my stocks and all my my assets are going up in price. Please, can I protect myself with more gold? No, that's not what happens. People buy stocks and bonds. Even bonds were doing pretty well. So this whole time, and then once that was realized that it wasn't consumer price inflation that was stoked for during QE, and it was just asset price inflation. Look, gold bear market for 10 years, 2011 to 2020 basically. It took 10 years for gold to come back to its previous nominal high. Okay, and that's after in 2020 they printed 6 trillion. Okay, so you had a massive bear market in gold, where we should have had a bull market, quote unquote, if you believe narratives. So that's what I'm saying. However, what did spike it up was uncertainty. People didn't know what was going to happen, so they just bought gold for safety reasons. And when it turned out to not be that great, boom, down. So now we have the same case going on here. Okay, we have a case where there's massive uncertainty, and that's why gold is ripping. It's also ripping because we're going into deflation, so you have both of those things going on. Like if I put on SPX, you'll see, if I compare gold to the S&P 500 again, you'll see that gold, as the S&P 500 dropped, gold is going up. Deflationary, people think it's recession is going to be, quote unquote, inflationary for tariffs, but what, deflationary for a recession? Like, pick your mind. What is it? You know my thoughts. I don't think it's going to be inflationary. I think it's going to be deflationary. So this is why the uncertainty plus a falling market is bullish for gold. Okay, so deflationary environments tend to be bullish for gold, but not always. But I'm pretty sure, more so than saying whether it's deflation or inflation, that I'm pretty sure that uncertainty will most likely keep a bid under the price of gold going forward. Thank you.